All good. Yeah. Okay. Great. Thanks very much for that. Yeah. So where were we? Credit Suisse. So could you start with Credit Suisse and just explain what's gone on with that?
Okay, Credit Suisse is a huge international bank based in Switzerland. Its main rival is the Union Bank of Switzerland, or UBS. These are two huge banks on the international scale. Credit Suisse has been around for 167 years. So it is not only large, but also a long-standing international bank doing all sorts of services, not only retail banking in Switzerland and Europe, but also what they call wholesale banking, which is lending money to corporations and so on, and investment banking, speculating in financial securities internationally. It's a big, big, big bank. However, over the last few years, it's been declining in its ability to maintain its market share and make sufficient profits for its shareholders and those who want to hold its bonds. So it's been weakening quite a lot. And in this current banking crisis, this came to a head because it was seen that it was unable to sustain any sort of profitable amounts, which would mean it could survive any run on its bank deposits. What we've seen over the last 3 weeks is a run on bank deposits in the US. So people taking their money out of banks where they've got cash deposits and savings, mainly companies or fairly rich people on the whole of these banks, relatively small banks. And then people felt, well, in Europe anyway, the investors felt that Credit Suisse was also in a similar danger, and it appeared to be money coming out of the bank pretty fast. And some of its leading shareholders were considerably worried, but weren't prepared to put any further monies into the bank. And it looked as though the bank was going to be in a position within days of being unable to meet its obligations. So if you've got 100,000 Swiss francs in Credit Suisse and you decide to take it out, you expect to be able to take it out and do what you want with it. But if the position was, if not so many people were doing that, we're talking billions within a short few days, that Credit Suisse was going to be unable to meet its obligations. So a crisis brewed up over the weekend. I'd say this again, that Credit Suisse has been a relatively poorly managed and weak bank over the recent period. And the general point I'd make to viewers here is that it's the weak that go first in crises. So in a while, it came to a head, and over the weekend, it was discussed what to do. One option was to pump money into Credit Suisse. Most people felt that was not going to work. And in particular, the Swiss government decided they didn't want a running mess continuing with Credit Suisse getting more and more money. They wanted a quick and decisive answer to this problem, a solution. So their solution, which was forced upon both the two big banks in Switzerland, Credit Suisse and UBS, was that they should merge. But in effect, UBS would take over Credit Suisse and they'll become one single huge bank internationally and in Switzerland. And that the Swiss government and the Swiss central bank would ensure that takes place. And the terms of that, Heiko, were that UBS would buy Credit Suisse for $3.2 billion, a tiny amount compared to even the market value of Credit Suisse at the point of this crisis, probably less than a fifth of the value of the market price of Credit Suisse, in return for which UBS would not only take over all the operations of Credit Suisse, but it wouldn't have any debt that Credit Suisse left. The Swiss government said that all the debt that Credit Suisse had, namely bonds that it issued to various investors around the world, will be wiped out. The bondholders wouldn't get their money, $17 billion worth. But the shareholders of Credit Suisse will get this $3.2 billion, shareholders including Saudi sheiks and others who were the main investors in Credit Suisse. So the shareholders got paid off. UBS got a bank with lots of resources and operations around the world for virtually nothing. And the Swiss National Bank solved the problem of withdrawals by providing UBS with a loan facility of up to $100 billion in case there were flows out of the bank.
So who took the loss? If you say the 3 point whatever billion is paid out,
So the people who took the loss out of this were mainly those people who had bought Credit Suisse bonds, first of all. So what happens is that Credit Suisse and other banks not only have money that they get from deposits from people putting their money into the bank as depositors, but they also borrow money from other banks in order to carry out their operations of lending and speculating. But also they issue bonds. They say, look, we're a powerful bank with lots of funds and lots of operations and profits. So you can buy a bond from us for, say, 5 or 6% compared to a government bond of 2 or 3%. And over 5 years, so you can make quite a bit of money, and you can buy and sell that Credit Suisse bond in the secondary bond market. So there was this massive amount of bond issuance made by Credit Suisse and other banks. And these people, now bondholders under the traditional rule of capitalist activities, finance activities, have first call on any resources if a bank goes bust or an entity goes bust. So what happens when a bank goes bust or any company goes bust? The shareholders are wiped out. So if you're an equity shareholder, you lose all your money. Then whatever's left over comes to the bondholders, starting with the primary bondholders. And then in this case, another layer of bondholders, which has been a new development, they come next and the shareholders last. But for the very first time in the whole history of European banking and busts, the Swiss National Bank insisted that the shareholders got their money and the bondholders lost all those. So the biggest losers are the bondholders. The second biggest losers are the employees of Credit Suisse. The employees of Credit Suisse, something like maybe 10 or 15,000 employees, and not all well-off employees, are going to lose their jobs internationally as a result of the merger.
Okay, so this precedent, is it a precedent? Is it now what will happen that the bondholders will be the fall guy for collapsing banks?
Well, first of all, Switzerland's not in the Eurozone. So the ECB, which was responsible for the Eurozone member states and their banks, has categorically said that this would not apply if a bank goes bust inside the Eurozone, that the traditional rules of the bondholders first and the equity holders afterwards would apply, so they say. But of course, this frightens a lot of people speculating around the world buying bank bonds in Asia and elsewhere. These are mainly hedge funds, pension funds, insurance companies, people like this who hold these sorts of bonds because they do a better rate of interest, are worried it's all very well for the ECB to say that, but what happens if one particular country in Europe, if it's not Switzerland, if it's Poland, or if it's Germany, decide differently? And I point out, Heiko, that there's a big debate about whether this was legal for the Swiss government to do it. I've just been going through the details of the legality with some expert lawyer, and he tells us in this long report that if you look at all the legislation and statutes to do with bonds and companies and so on, you can't do this. However, what the Swiss government did was, one day before they made this decision, they pushed through Parliament a law saying they could end an emergency. So the government has a completely different law from everybody else, and all the other arrangements and contracts made with the issuance of bonds, they've changed it one day before so they could carry this out.
Okay, the method used in the United States was also a little bit unusual. Do you want to explain what that was?
Well, somewhat different in that here, what are we talking about generally in the banks that have gone to the wall or near going to the wall in the US at the moment? It's again a traditional, what they call a traditional bank run. So what's happening is that depositors are taking their money out of their banks that they've deposited the money in. Why? Because they fear and have become to fear that the banks will not be able to maintain all these depositor withdrawals. They've been losing too much money, and that in that position, what assets they've got to pay back people their deposits they cannot get hold of because they're long-term assets. So, for example, if we take the Silicon Valley Bank, it had a lot of depositors, mainly small companies, tech companies in California, and they would deposit all the cash they were getting to carry it. There were startups mostly, the venture capitalists, those are people who invest in tech companies, would give, say, a small company $1 million to go out and come up with a new tech idea. And this tech company would employ 10 or 20 people, clever guys, to work on the idea, and they would be paid money out of the $1 million for their salaries. And that $1 million would be deposited in a bank in order to pay staff and so on. And in this case, SVB was the place to go if you were a tech company. So you put $1 million into the SVB for your deposit. Now, under the current US rules, anything over 250,000 is not covered by the state if the bank goes bust. You don't get your money back. So if most of the money in SVB wasn't covered by the deposit insurance level, because it was generally more than that, because it was small companies. And what SVB did was, okay, well, we're not going to be stupid, said the SVB manager. We're not going to invest all this cash into wild and weird stocks or derivatives and bonds like happened in the Great Recession, global financial crash. We're going to be very safe. We're just going to invest it in government bonds. That's all. What could be safer? The government's not going to go bust. And we can get a little bit of interest because government bonds pay 4% while we're paying 2% to our SVB depositors. But the problem is that government bonds are locked in for 2, 3, 4, 5 years, while depositors want their money immediately. So if you lock all the deposit money away into bonds, you can't get hold of it to cover a run on your bank. And a run on the bank began because they needed more money, because suddenly deposits were going down, because a lot of tech companies that had been making huge profits and developed suddenly started not to make huge profits in the last year and go the opposite direction. A lot of venture capitalists no longer prepared to put cash into these startups. So deposits were dropping away anyway, and the SVB couldn't cover these. And then it became clear that they're going to have to sell their bonds in the secondary market for way less than they were worth when they bought them. And they would make a huge loss in order to try and cover cash deposits. When that came into the open, then there was a massive run on SVB. And that's been applied to the other banks that have also been in trouble.
So is there a general crisis of profitability in the tech sector that could impact the banks elsewhere, the wider banking system?
Yes. What we've seen, viewers may find this surprising. Surely the tech companies of California are making mega profits. What about Amazon, Google, blah, blah, blah? But we're not talking about these huge boys. But by the way, their profits have been going down in the last year. They're still making huge profits, but nowhere near as big as they were a year or two ago. So the tech profit boom is over. But these smaller, medium-sized companies not only are losing profits, they're actually going into deficit in many cases and starting to go bust. And they're usually financed by venture capitalists giving them a load of money for 2 or 3 years to see if they come up with something that's profitable. So they burn this cash. It's cash burn for 3 years. And then if it goes down, it goes down. Now, all of these are starting to collapse. It's not just in tech. It's also starting to happen in other areas like biotech and pharma and so on, where these startups are very common. So we're seeing a significant downturn in the profitability of these boom sectors in the past. And that is in causing creating the situation. And there has been a general failure of profitability to rise in the last year. In fact, it's going in the opposite direction. All talk about huge corporate profit margins, but they're going south now. And that's having one end of what is the problem. The other key end of the problem is that if you can borrow money at nearly zero interest rates, maybe if your profits go down, it doesn't matter. But the Federal Reserve, for the last year, has slowly been hiking up interest rates in order to control rising inflation. And that has a spread effect across all the cost of borrowing in industry, commerce, and finance. And so to borrow money now isn't going to cost 0.5% or 1%. It's costing 4, 5, 6, 7% now. And that's squeezing at the other end the net profit that these companies can make. So loads of companies are now moving into loss, these small to medium-sized companies that have been putting their money in these small to medium-sized banks. And so that situation hasn't altered. And tomorrow, today, actually, the Fed will be deciding whether to hike rates again, and we expect a further hike. So further squeeze on the value of these bonds and on the cost of borrowing for these companies.
Okay, well, I'm sure a lot of people want to know, because it's a widespread discussion in the circles I know. Digital banking, central digital banks, digital currencies. What are they? Where are they likely to be introduced? And what's the difference?
Well, we've gone pretty much digital now, haven't we? In a sense that if you go out to purchase something in the shops or pay your energy bills and so on, you don't do it with cash. You don't do it with even checks. You simply do it by a press of the button on my computer now. While I'm talking to you, I could go into my internet banking system and do all the transfers, and that's completely digital. So in that sense, digital money has dramatically increased. What this is suggesting is that even at the level of central banks and on international currencies, we could be in the position where central banks would have a digital currency, and that all the banks and we could actually operate an account directly with the central bank that is digital, and that they would actually offer a deposit service and so on, which the commercial banks have. So in a way, it would start to bypass the commercial banks in this operation. Why would you want to do that? Why would central banks and governments want to do that? Well, they're very much in favor of wiping out cash, because that means that we are entirely dependent upon banks and ideally on the central bank for all our transactional activities, so that we're completely in the control of central bank policy and government policy if we wanted to do that. So that will be a big advantage for controlling the money supply, and even perhaps in their views controlling transactions and inflation and economic activity more accurately. So that's one reason. Another reason is that small countries see the idea of having digital currencies and having control by the central bank over digital countries of a way of avoiding international fluctuation in the value of their currency, if they're the peso against the dollar and so on. So these are methods by which we're supposedly going to improve the efficiency of transactions by using it digitally and giving more control and over the management of currency in the economy to the central banks and governments.
And how advanced do you understand these processes are?
Not very. I think we're still a long way from having digital currencies being applied by central banks and governments across the board. We have an attempt to, for example, apply cryptocurrency in places like El Salvador, which is a digital cryptocurrency now, which has been, frankly, a disaster because, of course, most people still don't trust cryptocurrency as a real means of exchange and to operate there and to borrow and to do their transactions. So as soon as they get cryptocurrencies, they generally transfer them into national currencies, whether it's a dollar of their own country. So there's I don't think digital currencies on a wider scale are coming in very quickly, but increasingly it will be the case that there'll be if we have more banking crises and this situation, it will mean that the central bank and governments will be attempting to bypass commercial banks and operate, used to be called the Chicago Plan. Chicago Plan was that the central bank would do all the placing of deposits and loans for the individuals and for companies, and they would bypass commercial banks. Commercial banks would only exist then in order to carry out investment and speculative activities. They wouldn't deal with the retail and wholesale banking aspects, which is the main thing that concerns us as individuals. And so we move towards a more centralized control of the money supply and of transactions.
I mean, I remember 1990 in Germany, they very rapidly moved from we're not doing any of this to suddenly the entire currency was removed and another currency was introduced. The Germans have done that a few times, I think. I mean, is it like part of the scheming of the, if you like, central governments to plot such an agenda that if the banks were to collapse, that they could move on to a digital currency rapidly?
Possibly. I think we have examples already of what you've talked about. In India, for example, the Modi government said that all a range of small note currencies, these are notes because India still operates very much on cash, notes and coins, said all your notes up to, if you had very high value.
Over 500 or over 5,000.
Yeah, if you're 500 rupee note or something like that, which is very high, easy to counterfeit and therefore create a lot of money for somebody illegally. They said, you've got to bring them all in and we're replacing them with a completely different note. And that has to be done by this weekend. This caused absolute chaos for a few days because most people don't have bank accounts, or they offered, of course, to go to a bank account and try to get people into the banking system. And that's happened on a few occasions. The argument there is, well, we have too much counterfeiting and we have too much danger of inflation out of counterfeiting. And that's why we did it. But as you say, it also provides, if they can do that and move people out of cash into bank accounts, then there's more control for government and the central bank over the money system as a whole and people's transactions. Because going back to Credit Suisse, if everything's digital, then it's very good for the central bank. They can just completely block all your transactions in your bank overnight or within seconds, if that's what they wish to do, because your money is no longer under the mattress. That's why people used to hide their money under the mattress and hoard it, because they didn't trust banks to look after it, and they were worried that they would not be able to get their money out of a bank. And so people preferred to keep it in cash, hidden in their house, and hope they don't get robbed. But those are the issues that are involved in this. Digital.
There was a few years back, there was a plan by Facebook to introduce something called Libra.
Yeah.
Sort of a digital currency linked to other currencies. It seems to have collapsed as an idea, but are there private sector companies doing this? Is that where all this crypto hype has come from?
Well, when the crypto hype starts, we get the idea of having private digital currencies. As you say, the most well-known one is Libra, which Facebook came up with, or Meta as they call themselves now, came up with to say, well, okay, if you do any transactions through which involve Facebook advertising and so on, you can have a Libra account and you can do everything in Libra. So it's a bit like doing everything in Bitcoin. The same idea. This Libra would not be a cryptocurrency in the sense that it would be linked to a basket of well-known currencies, and it will be guaranteed by a reputable bunch of international banks. So that was the idea, but it didn't really get off the ground because, as we've seen, that since then, the whole idea of digital currencies, or cryptocurrencies to be more exact, has come into disfavor, and the idea that this is going to spread and develop. And on the other hand, and also the fact that Facebook has gone through a period of relative decline in the last 2 or 3 years. So this idea of expanding beyond social media into a semi-banking role has been put on the shelf.
Okay, just coming on to the issues of artificial intelligence, because I saw Bill Gates came out with some comments about the chat GTP and all the new rollouts of all the different artificial intelligence methods. I remember you speaking some time ago, or writing an article some time ago, where you were saying that in a lot of the top banks, you might have, say, 3 people who are CEOs and have the decisive vote, and one would be an artificial algorithm. To what degree is artificial intelligence dominant within the global economy?
Not yet, but it's moving fast, I think. I think we could say that artificial intelligence is definitely going to be the big issue, both for us as people working, trying to make a living, because a lot of jobs can be replaced by these when we say artificial intelligence, we mean not just a computer or a program, we mean machine learning program. It supposedly learns more, and therefore knows more, and doesn't make the same mistakes as before, and become more and more efficient, and also can actually enhance the thinking process, the thought process. That's the idea, and therefore people like myself can be replaced by an artificial intelligence digital program, which continually knows much more than Michael Roberts, the economist, knows, or even the head of the central bank knows about the subjects they're supposed to know. So people like economists could be wiped out by artificial intelligence. People who do actually proper jobs, which are necessary to help us all, like working in hospitals, like cleaning up the garbage, like transporting us around, those can't really be replaced yet by machine learning artificial intelligence. Although I suppose you could consider that self-drive cars that don't crash into other cars or self-drive trains that stay and keep to the time, all those things are possibilities out of the development of machine learning and artificial intelligence.
It seemed to me that the Boston Robotics machines, they got these
sentient looking machines,
and now they're standing, jumping, doing somersaults, and all the rest of it.
Yeah.
If they're integrated with artificial intelligence, what does that say? What does that do to the idea of the sort of labor theory of value? Could they replace man with machine and just wipe the rest of us out who are not useful to them?
Well, not in our lifetime, neither yours nor mine. Of course, I haven't got much left, but I would say the majority of people who are watching or listening to this, not in their lifetime either. It's going to take a long process before we reach the position where human labor power is no longer relevant to the production of things that we need and use, and therefore value is no longer created under the process of capitalism. But this is a hypothetical argument. If you had,
would the command to the machine to do the thing constitute the labor value?
Well, yes, at the beginning, so that mental labor will still dominate over objective labor. That's labor that we see and feel and hear. But let's just think the hypothetical argument is that maybe robots or machines or AI can make robots that make machines that make robots. So the whole process becomes completely robotic and human labor is not involved. Does that mean value in the sense that we mean as Marxists, which is that value is only created by human labor working to create value for things that we need and use, would disappear? And the answer to that is yes. In a capitalist society where human labor is necessary to be employed and exploited in order to create value for capitalism to make profits out of, would disappear because there would be no human labor involved. And basically, we just have a machines labor. It was slave machines, if you like. So then the question, but we'd also have no profit because in my view, profit is only created by the expenditure of workers going to work and being employed by capitalists. But if the capitalists have only got machines and they haven't got any workers, then what are these machines for? Because workers will no longer have any money because they won't be working unless they're going to be given money by the capitalists.
Yeah, you could do this, what they're talking about, UBI,
Yeah, but then basically what you would have is a system where machines produce things and the owners of the machines give everybody the value from those machines, namely the use values I'm talking about. The things that
they could sort of, that would mean an entrenched kind
there would be no process of competition. There would be no exchange. There would be no exploitation. Simply, there would be virtually what you might call a socialist economy, namely things would be produced and you consume them because the robots would be producing them and you consume them. The only difference might be that the owners of the robots are still in the hands of a very small number of people. But what would be their advantage in having that? Because all they'd be doing with the stuff they produce is to give it to you to consume. So yes, they might have a bit better yacht than you or something like that. But the implication here, if this is completely hypothetical, the implication here is that you wouldn't have a capitalist system anymore. It would be some other sort of system, which would be production directly for consumption, which is much closer to a socialist system of the mode of production.
Well, I mean, a socialist system, but that would then be like a slave owning.
Yes, the slaves would be robots, not us. It'd be much more like the Roman Empire, I think you could describe it, where the aristocrats had slaves on the land, which they had got from military conquest, and they worked the land. Workers like ourselves and labourers on the land will have been kicked off. They don't need them anymore. They go into the city and hang around with no money and nothing to do. So the aristocrats, to avoid a riot and a revolution, organize games for them and provide them with free food and other facilities, so that we would sit in the countryside getting free food and facilities from the aristocrats, from the owners of the robots, and the robots
behave.
Yeah, so that would be a sort of it would be a consumption society controlled by provided by robot production and controlled by a very small elite. Now, I'd have to ask myself how long that could last like that, while 99% of us sit around waiting for the aristocrats to give us food and supplies and houses to live and all the rest of it at their whim. And if they didn't, then there will be, well, I can't imagine they would last too long.
Okay, one final thing on the banking system. So what likelihood do you think that we're coming towards a new 2008 or worse? So what's the likelihood of a generalized crisis in the financial system and a generalized economic slump?
I don't know. First of all, I think the first question, will there be a financial crisis that will develop to the same level of intensity we saw in 2008-9, when starting off with some weaker banks having a bank run, then moving on to a complete crash of major banks, Lehman's, Bear Stearns, and then all the mortgage companies, huge mortgage companies crashed. Are we going to have that again? Well, it's first on the yes side of that argument is that Silicon Valley Bank was not a small bank. It was the 16th largest in the US, and it's the cost of the bust, or the loss of assets, is the second largest in the history of banking in the US after Washington Mutual in the 2008 slump. So in that sense, it's already big. And we've just seen the loss of one of the major international banks in the world, Credit Suisse, coming out of this crisis in just 3 weeks. So that's the yes side. Now, the no side to whether it will spread is, first of all, we're not dealing any longer with an overextension of the financial markets into real estate, mortgages, weird instruments of derivatives and so on, which led to an international spread of this collapse from the real estate market in the US into mortgages and derivatives and then internationally, because everybody bought the same stuff. But we're not in that. But we possibly are in a collapse of the bank bonds. If that spreads, then that could have a bigger effect across the world. But the difference here now is that this particular banking crisis is being caused by two things. First of all, a relative decline in profitability, squeezing at one end, and a relative rise in the cost of borrowing at the other end, because central banks are hiking rates to get inflation under control. Now, if those two parts of the crisis continue, then I think we will have a further spread of this crisis. But that could be changed, because the central banks could decide, oh, crikey, we're now looking to having a banking crisis internationally. We better stop hiking rates. We better reverse the process. We better start giving cheap money out again to keep the banks and companies going when profitability is falling. So let's cut interest rates, not raise them. Let's inject more credit in, not tighten it up, which is what they're doing at the moment, and reverse the policies of the last 18 months. Well, I can say that I suspect today that will not happen. Last week, the European Central Bank raised interest rates again. I expect the Federal Reserve to raise interest rates again today. And tomorrow, the Bank of England is going to probably raise interest rates, even though because inflation is still rising in the UK. So they're going to continue with the existing policies. So that means the squeeze is still on at the interest rate end, and therefore on bank bonds. So we could move into a further financial collapses in different banks over the next few weeks and months. If that happens, then maybe the central banks will be forced to think again and reverse their policies.
And a prospect for a general economic recession?
Yes. Well, just to finish, President Lagarde of the ECB said there is no trade-off between fighting inflation by raising interest rates and preserving financial stability. But of course, there clearly is a trade-off, and that trade-off may have to be decided upon over the next few weeks or months by the central banks. But if they continue with the policy that they have now, then we are going to go into a slump. Germany will, Europe, major sectors of Europe will be in a slump in this quarter. That will be confirmed not until the next quarter. The US is slowing down fast, contrary to, even though we appear to have virtual full employment and so on, every other aspect of the US economy is going downwards. UK is the only country, according to the OECD and the IMF, which is already in a slump and will be in a slump. So I don't see any reason to suspect that we're going to reverse that process. So even if it's not an outright slump this year, pardon me, we are heading towards virtually zero growth. And if profitability keeps falling and interest rates keep rising, then that's going to squeeze economies further. So the G7 and the major economies are likely to drop into a slump by the second half of this year. And as for so-called emerging economies, several of them are already into serious difficulty and are bust. Sri Lanka, Pakistan, Egypt, Ghana, Bolivia. Across the board, we're seeing the inability of these countries to pay their debts. And that's the situation will expand over the rest of this year.
Okay, thanks very much, Michael. It's been appreciated. Speak to you again sometime soon, yeah?
Okay, thanks, guys.
Ta-da.
Bye.